Hello, hi, good day. Today, I woke up at 4:46 a.m. I looked at myself in the mirror and realized that with all the travel, no gym, and business lounge upgrades, shout out Revolut, I had gotten fat. And since being average is what we did in 2022, this morning from 4:47 a.m., I hit the gym, had 2 poached eggs, recorded this video, bought some QQQ, and even played blackjack with Harry Dean Stanton.
Thank you for your diary.
But the real issue isn't the fact that wifey slightly overcooked the eggs, it's those fucking bulls. I swear to God, if one more bull sells one of those petty CNBC news events, I will run for president and when elected, issue an executive order for mandatory $19 trading commissions in the US and T+30. And for all the keyboard warriors in the comments telling me you need to be a US citizen, I got 2 words for you, buddy. Barack Obama. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500. And when you look at this just from a bird's eye view, you see a lot of red. And you would say, yes, breadth was generally bad while the S&P 500 was flat. Same old story we got for like the first 3-4 months of 2024. Tech leading the way, Nvidia, Apple, most of semiconductors, equipment manufacturers too, and then, software finding footing where it can. But there were some notable things we do have to talk about. We did see United Health up 1.3% today, in the context of utilities actually being slightly in the green. It doesn't look like it. Utilities did finish positive today, and then energy as well as certain places in commodities were also very, very green. It doesn't look like it, but gold was actually very positive today. Gold miners on the back of higher commodity prices and Barrick Gold's earnings. We also did see Walmart and Costco, so the growth component of consumer staples, get bid up. So really today was just a day for large growth. Technology and then energy and utilities continue to be upbeat. Now, this is a bit concerning. We were talking about yesterday what we really wanted to see in this market. We want to see utilities, staples, or the defensive components of staples sell off. And we want to see cyclical sectors outperform, stuff like technology, energy, discretionary. And so we're still seeing a constant bid in utilities that is telling us that there's still some market fear under the hood. Big players, institutional money positions into utilities as a defensive sector. A certain percentage of their funds needs to be invested, and they get defensive by going into utilities, going into staples. And to see a bid up in utilities in the context of the market price action we saw, most sectors were down. That is somewhat concerning. The worst performing sector was communication services, real estate as well, consumer staples. All in all, really most sectors were just down today. I think what the market is really doing is just biding its time for the PPI report tomorrow, the CPI report at the end of the week, and retail sales. We got a heavy week of data, and so I think the market was digesting last week's price action, digesting some of the global news we saw in the Middle East. The yen carry trade is abating, and there's still some of that fear underneath the market. In that case, you buy quality, that's technology, and you buy utilities, that's defensives. And then energy was bid up on some geopolitical news as well as energy prices. And you're really just going to sell the rest. You don't really want your money in these sectors, especially not leading up into the week that's going to come, Tuesday, Wednesday, Thursday. And we saw much of the same across the size spectrum of the market. Mid caps, small caps, high beta, lower quality names got sold off. Small value down 1.1%. Absolutely shocking. They got sold off, and we did actually see a bit of a rotation into large growth, large core, the larger components of the market. And that is why the QQQ was up 0.23% today. That was mostly led by the moves in Nvidia as well as Apple. The S&P 500 was pretty much flat here on the day. Some quotes say flat, some say up 0.005%. Inconsequential in my mind. The real losers definitely were small caps. The IWM fell 0.86%. A brutal day here for small caps, but we spoke about the rotation and what's going on under the hood, and the market just waiting and still brushing off a lot of the fears from last week. The equal weight was in the middle. Bonds did gain today. The TLT was up 0.34%, one of the best performing asset classes, and that's because yields fell about 1%, especially in the longer end. The 10-year and 30-year yield. And then commodities had a very bullish day. Gold was up 1.72%, silver gained just as much, and the big winner was crude, up 3.4% for the day. A very, very solid day in commodities. So diving into the S&P 500 a little bit more closely, and we saw some major changes with the gamma chart. Now, the gamma flip is still at 5,300, but what we actually saw was the core resistance moved up to 5,450. The put support actually moved down to 5,250. So we've seen a bit of expansion in these. This often occurs when we do get big data points. It's just the market showing a bit of jitters, showing a bit of pain, hedging on both sides of the table, and just a little bit of expansion of volatility after the bit of the compression we saw on Friday. So, above the gamma flip, we're buying dips, selling rips to the 5,450 area, and below we're looking to the 5,250. But we want to see where this repositions tomorrow. I mean, if this moves up to 5,300, this stays at 5,450. That's kind of bullish. The gamma flip will probably move up in that case. That is a bullish sign, and we probably look to the long side, especially if we do get a better than expected PPI print. PPI is going to tell us everything we need to know about the CPI print. So tomorrow, that is going to be the big driver. However, there can be slight divergences between what PPI shows and what CPI shows. So I wouldn't take this PPI with complete certainty, but you'll have a pretty good picture as to what to expect from the CPI tomorrow. We definitely don't want a hotter CPI, especially with the jobs numbers we got. The market is still battling with that. I know initial jobless claims did work some of that fear off, but if we get hotter than expected PPI, CPI, things are not looking too good for the market, and I think that will probably just sell on the macro regardless of what the technical picture is telling us. So big data print tomorrow with PPI, and the expectation right there for the month-over-month figure is 0.2, and for core 0.2 as well. So that's what you want to look out for. If the numbers come in even slightly hotter than 0.2, things are not going to look good for the market. But if we come in line, that should be a little bit of gas for the market to move higher, or at least for us not to continue the selling we've seen right here. At the same time, we're also at a very key level. If we go ahead, capture this high tomorrow, and that would mean PPI came in better than expected, this probably opens up the call gamma resistance at 5,450. It's the gap we made right here on this sell-off, on the gap down, and that would be constructive. If we go and retake the 5,450 area, I think that all but assures new all-time highs, probably in the month of August, or very close to new all-time highs here in the month of August. But if we actually fail right here, continue to move lower and break some of the key levels on the way down, this low and this low right here, that can spell a bit of trouble, and then the bulls are going to have to work really hard to hold these levels. So we are at a critical point. The bears need to make a move right here, and the bulls need to stop them. And what the bulls need to do is really just push and start to take some of these key levels. They did a great job in retaking this low right here and just retaking back the 5,250 and 5,300 areas, but there's still more work to be done. I would also watch yields tomorrow, how yields react. It seems we found resistance right here at the 4% mark for yields. We want to see if we're actually going to continue the trend we've seen in the last couple of months. That's lower lows, lower highs, and if we are going to go ahead and break that low. If that is the case, then the market is really pricing in a lot of rate cuts. We were pricing in 4 rate cuts right here. We're looking at about 2.5, 3 rate cuts at this point right here. So we're going to see where the market trades. In my opinion, I think the truth is somewhere in the middle. I think anywhere between 3.8 and 4 is probably where we're going to range, unless we get like a recessionary fear, a growth scare. Then we're probably going to move below this 3.7, closer to the 3.6 range. But as it is right now, I think the market likes where yields are right now. The market pricing in 2 to 3 rate cuts into the end of 2024, and I think 1 rate cut by September. That's what the Fed is signaling, and that's probably what the market is pricing in right now. We were a bit overextended here, 4 5 rate cuts into the end of 2024. That's a bit much right here. 2 to 3, I think that's great. So you want to watch yields tomorrow. You want to watch the data tomorrow. Everything will move on the PPI tomorrow. If it comes in good, expect a rally in smalls, mids, large, everything. On this channel, every single week, we do the weekend poll, and we pretty much ask the question this week for the S&P 500. Are you bullish, bearish, or neutral? And what a stark difference compared to last week. These two right here were pretty much flipped. About 50% of you were bearish. Now 50% of you are bullish, and likely so. We literally saw a bottom formed in the S&P 500 last week. We did pull back Wednesday into Thursday and then moved higher into Friday, forming a higher low. That is constructive. And looking at some seasonal stats, when we've had a 10% year into July and a negative first 2 weeks of August, we normally see outsized returns, but not without some volatility. In fact, the last 2 weeks of August 14th to August 31st, we can actually see negative returns, on average negative 0.53%. In other words, when we've had a first 2 weeks of August that are negative, in a positive year, we actually see the end of August be negative, but on a median basis, it is a little positive. But then we tend to see September, October, November, December, and January all extremely positive, up 1.89, 0.74, 3.67% here in November, and 2.1% in December. Then we get the new year up 1.27% for a full year total return from August 14th to January 31st of 9.34%. And the risk to reward is asymmetrically skewed to the upside, and that is why I've been very vocal on buying the dip, because we will go higher into the end of the year. And the truth of the matter is, August during election years is actually when we normally see a low. 46% of the time in that year, August marks the low. September rarely ever marks a bottom, and then in non-election years we can actually see October can also mark a bottom, as you can see with this data right here. But in an election year, it's very likely that we will put in the bottom in the month of August. At least this is what history tells us. And while this isn't a crystal ball, it does allow us to assess probabilities, and the probabilities suggest 46% of the time August marks the low in election years. And the truth is, we can actually see an impulse move lower. Normally what happens after a 10% correction, we take about 3 months to break out of this range right here. We form a bottom, then we rally, then we have a second impulse move down where we form a higher low and then move up. Now, I'm not talking about the higher low we formed mid last week. We're probably looking towards the end of August here, post OPEX in the window of weakness. Maybe we form a low and then move higher. Now, this isn't a prediction. I'm just saying that the probability suggests that we do get an impulse move lower. Smart money likes to do it, shake out the weak longs, and then catch as many people offside, both the bulls and the bears. And that's just liquidity for the next move higher into the end of the year. And that's why you just want to sit through any volatility we get and just play the long side. But regardless of market momentum, earnings are holding up. Now, we did see a decrease in earnings right here compared to the start of the week. At the start of last week, earnings expectations were about 13% and now sitting at 12.4%. And that's okay because it's still above analyst expectations, and revenue is well above analyst expectations. In fact, revenue expectations moved up from 5.1% to 5.3%. But the huge story is actually margins. Margins at the start of last week was 12.1%. We saw 10 basis points worth of an uptick in overall margins. This was the analyst expectation. We're seeing a huge margin beat. And at the end of all of this, guys, 78.2% of S&P 500 companies are beating analyst expectations. The long-term average is 66%. And any dips we do get, you want to buy because the fundamental picture looks unchanged. But where does that leave us with valuation? On a PE basis, the S&P 500 right now trades at 20.4 times on a PEG ratio of 13.1 and a free cash flow yield of 3.30%. Some of these sectors are starting to look mightily attractive. I mean, just about 3 to 4 weeks ago, this was trading at about 21.4. We've seen a huge pullback in the market, as well as a huge pullback in forward PEs, coupled with better than expected earnings expectations. That actually increases the earnings side of the PE multiple, which means the overall PE is going to fall as well. So we had two effects. A bit of a pullback as well as earnings compression has led to the S&P 500 approaching its fair value. I consider a 20 PE to be fair value. Anything below is undervalued. Anything over is slightly overvalued, but most of this is driven by consumer discretionary and the tech sector. If you look outside these two sectors right here, things look mightily attractive. I mean, industrials trading at 20.7, consumer staples 20.6, and then you have every other sector, materials, healthcare, comm services, real estate, trading below the actual market multiple of the S&P 500. Very interesting. And look at comm services. I love this sector because on a free to cash flow basis, it's trading very attractive. Look at that earnings growth, 1.1 PEG, 18 PE. That's a very, very attractive looking sector. And I think Google right now at 19 times forward earnings, super great buy. I've been buying a lot of Google. I think Meta's also trading at like 23 times, but Google actually looking very, very attractive. It's even cheaper than some of the telecoms on a price to earnings basis. this. So this is where I would look for value and growth. The comm services sector, I would look there. I also wouldn't look past financials if you want growth, value, and a sector that's actually going to benefit from rate cuts. And then if you're just looking for absolute value, you can look at something like the energy sector. And don't forget that at the end of the day, the long-term driver of stocks is earnings, and S&P 500 earnings is simply growing. We are officially out of the earnings drought, and as long as earnings keep going up, any dips we do get are just viable opportunities to get long. Looking at earnings today, not a huge week of earnings, but there are some notable names: Alibaba, Walmart here on Thursday. We also have Home Depot tomorrow, CNU, names like Cisco, AST, D-Loco, and Stone on Wednesday. But today we had two companies, big players in their space, but not market movers. Monday.com, this is actually a social media scheduler. I use this for a lot of my own businesses, a great little product. And Barrick Gold. And Monday.com was up like 14% during the day. That's because they beat EPS expectations by like 60%. They expected to report 0.56 in earnings. They reported about $1, just under $1. And this was just on better revenue as well. Revenue surprise came in at 3%. So a lot of operating leverage management happened to find in this quarter. Barrick Gold also reported stellar earnings. EPS, they beat by 17%. Expected was 0.27. They reported 0.32. This is on revenue of 3.16 billion, a 1% surprise to the upside. So fairly upbeat names right here. Probably helped the subsectors in each name, but fantastic earnings from these two companies. Now looking at some macro, and we've seen some very interesting developments in overall GDP predictions for the third and fourth quarters, as well as 2025. Previously, the consensus expectations, these black boxes right here, for the third and fourth quarter was sitting around the 2% mark at this point right here. We have since seen these come down significantly on the back of the weaker macro we've received over the last couple of weeks. However, Goldman Sachs are the contrarians. They still see 2.6 and 2.5% GDP here in the third and fourth quarter, and a robust growth environment for 2025 above the 2% mark. The consensus see improvement into 2025, but still well below Goldman Sachs expectations. And a lot of this has to do with weaker macro. We have seen weaker economic data, but that's why we're in a cutting cycle, or approaching the start of a cutting cycle. Rate hikes were meant to do this. The whole point of rate hikes was to actually weaken economic data, temper inflation. But what the market is worried about, did the Fed wait a little bit too long? And that's why we saw the credit markets for a very short time last week price in a recession. This blue line right here is the market pricing in a recession in the Fed funds rate. And we did see credit spreads in the high yields blow out. This didn't happen in the AAA and BB corporates, but we did see it in high yields. Things are normalizing, but we have to see how this pans out. Will it continue to come down, or are we actually going to have elevated high yield spreads for the rest of this quarter? And with the macro coming into focus in the last couple of weeks, we are going to have to pay close attention to the data, because that is going to drive a lot of the flows this week. And we have an important week of data. Now, we don't really have anything on Monday. We have the budget statement. Tuesday is where things heat up. We got PPI, headline and core, as well as Fed Bostic speaking. The expectation there on the month-over-month figure for the headline is 0.1, and ex-food and energy 0.2. And then we're expecting a 2.6% and 3% headline core print. Then on Wednesday, we get CPI, headline and core. The expectation is 0.2 for both headline and core, the month-over-month figures, and then 2.9 and 3.2% for the headline and core year-over-year figures. Then on Thursday, we have retail sales all in a single week. So it's Tuesday, Wednesday, Thursday, big data prints. Retail sales here on Thursday, as well as initial jobless claims, Empire State Manufacturing, and then Fed Harker is speaking. And then on Friday, we have building permits, housing starts, University of Michigan sentiment, a huge week of data. You're going to want to be watching the economic data, because the market is extremely sensitive to economic data right now. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.